This buyer purchased a $2.9 million primary residence in North Carolina. We structured it as a non-QM full doc loan, qualified off of tax returns, used a minimum down payment, and got him pricing through one of our big retail bank partners, which is exactly how we landed at a 6.75%. Our client's long-term plan? Tear down this property, rebuild it from the ground up later. Let's break the entire deal down. What is going on, guys? Welcome back to another deal of the week. If you are new here, my name is Ricardo Carrillo. I run RC Lending Advisors. We're a nationwide mortgage lending company that helps clients all across the entire US get financing for both residential and commercial deals. Whether you're buying your first home or scaling your real estate portfolio, my team and I will walk you through the entire process from A to Z. The whole point of these videos is for me to show you the real deals, the real numbers, and the real clients, exactly what it is that they're doing and how we are structuring these deals to make them as successful as possible. This is what happens when you actually do this the right way. Now, this specific deal was a non-conventional loan. We did it as a primary residence for our client in North Carolina. And the reason why I wanted to talk about this deal today is because there's so many high earning clients that we work with and people out there right now who think that their only options are to use a conventional or a jumbo loan. And they're actually missing out on one of the most powerful loan programs and product categories in the entire mortgage market. So let's get into it. This property was in North Carolina, just outside of Asheville. Our client's actually purchasing this property as a primary residence. They plan to live in the home, and in the future, they want to do a massive property that they're going to tear this one down and do a complete rebuild. Now, we ended up locking in a 6.75% on a 30-year fixed. We did a 20% down payment. 20% down was actually the minimum that was required at this price point, and that left our principal and interest on the loan at $18,900. Now, where the strategy really comes in was that this was a non-QM or non-conventional full doc loan. I want to walk you through exactly what it is that means, because the term non-QM gets misunderstood constantly. Non-QM stands for non-qualified mortgage. That sounds technical, and people hear it and they think that, okay, this is going to be a worse loan than conventional financing, when that is not actually the case at all. Conventional loans are also called QM loans. And they're loans that fit inside of a box of set of rules set by Fannie Mae and Freddie Mac. These are actually the same specific guidelines around how income's calculated, what kind of documents are needed for pre-approval, what your loan limits are based on where you're buying, what kind of properties could qualify for this financing, and also how the bank is required to review that loan. Now, if your file or your loan fits inside of that box, great, you can get a conventional loan. Non-QM is everything else that fits outside of that box. So loans that fall out of that box for whatever reason, it could be reasons of all kinds, meaning loan size could be above special limits, self-employed clients, someone who is a business owner, it needs to be calculated differently than a W-2. It's property types, things like a treehouse, for example, where conventional financing won't touch it. It's borrower profiles, clients of ours who need more flexibility because of how their income is calculated. Just because it's non-QM doesn't mean that it's weaker. It means that it's actually custom. It means that the loan was actually built around a specific situation for you instead of forcing you to fit inside of a box. And the full doc piece is actually important too, because there's non-QM products that use bank statements instead of qualification of taxes. There's ones that only use bank statements, which is like your assets, for example. There's programs that don't even look at income at all. And because this one was a full doc loan, it means that we actually provided everything. Tax returns, the W-2s, the mortgage statements, the bank statements. It's a program that fits inside of the non-QM bucket. And it's different because this was actually better for our client than having to use a traditional jumbo loan. What does that actually mean for our client, though? It's the interest rate. So this was actually the play. When you're financing a $2 million property or properties in the $2 million range, you're typically going to be looking at jumbo loans through traditional banks. All the big banks, they will offer a jumbo loan because it's higher than specific limits, but those rates could be all over the place depending on the lender. Sometimes you could have a banking relationship, and your overall profile, it can make things different. Some buyers get great pricing, others don't. And high net worth clients who are looking for the best pricing are usually the ones that have high deposits, and so then they get preferred pricing that way. But there's actually another plan. We can use big retail banks who offer non-conventional full doc loans, and we can do that for you just the same way that Expedia gives you pricing for airlines. Our job is the same. We do the same thing, but for these kind of jumbo loans. And the rates of these programs are extremely competitive, sometimes actually even better than what these clients will find when people call me and they're like, hey, Ricardo, I spoke with my banking partner. Can you get me something better than this? 9 times out of the 10, we actually can. And it's for that specific reason, is you're not getting one specific bank's pricing. If we had ran it through a non-relationship jumbo lender, then let's say in the same example, they might have gotten something in the 7s or 0.5% to a percentage point higher. This is why the placement of the loan actually matters. And getting into the long-term strategy is kind of interesting for this specific deal because our client plans to build a dream home and they want to be able to tear this one down eventually, which would allow for us to kind of do a restructure, do a different loan program, refinance this in the future once they're ready for a strategy like that. We've had many clients who've done that. Typically, they want to have more custom homes, so we just go down the route of creating something different that works. This is a strategy that you see often for a lot of our high-end buyers in destination markets. It's properties that are in these established neighborhoods. There's limited inventory. They want to make something that really stands out. And they also get long-term appreciation. The buyers who actually purchase right now tend to be the ones who get to lock in the location and the lot, especially if it's in a market like this where they're not building a ton of new real estate in a very small central location. For financing though, this was a phased approach. You buy with traditional financing on an existing property, and then when you're ready to tear down and rebuild, we refinance that into a construction loan. Then once the building is completed, we refinance that into a permanent loan. So it's kind of 3 financing events, right? You do the purchase, a refinance, and a refinance. And the thing is that some buyers, they try to skip that first step and then they just go straight into the middle and doing a construction loan, which works. It just can sometimes create a little bit of complexity. Construction loans on teardowns are, like I was saying, a little bit more complex. Sometimes the rates are higher, the qualification can be harder. And so oftentimes we find that it's easier for people to buy and hold first, and then we do a construction loan later. This is exactly what our high-end clients and our high-end buyers do when they're thinking about a property long-term like this. They're not just actually buying a house, they're buying the location, they're buying the positioning of that property, the land, and the financing today is just one piece in a longer plan. The takeaway on this deal is simple: the right product, the right placement, and then the right strategy. And all of those 3 things, they produced the results that most buyers and most loan officers don't even know are possible. 6.75% interest rate on $2.9 million. And it's a crazy market with non-conventional financing. We closed in less than 30 days. It's just overall, it's amazing that we were able to provide that opportunity for our client. And that's the result of putting a file like this or a loan right in front of the right bank who we know is going to be able to have the right product. If you're looking for a high-end primary residence purchase, you have a complex income profile, you have tricky financing, or a property that's going to need more than one phase of financing over the years, you need somebody who understands what you're doing, who understands how to map this out for you and explain to you exactly what it is that you can do to be successful. Go to rclending.co or find me on Instagram at Richie the Lender. My team and I work with buyers and investors all over the country. I appreciate you guys so much for watching. And if you haven't seen my other videos, first of all, go check those out. You can check it out either here or here. Make sure you like and subscribe. I will see you guys in the next Deal of the Week.